so we're going to fly through it. It's merely a brief overview. We'll touch on a lot of things, maybe not too specific, but certainly if anybody wants to ask questions at the end, I'll try and go into a bit more detail. So, introduction simple enough. Me, hi, I'm McWilliams. Cash flow management. Things to look for, the warning signs in cash flow. If you don't know you've got a problem, it's hard to fix it. If you know the ratios and the indicators as to why you might have a problem, and we'll only look at a couple of these, but there's a couple of very good ones. Debtor days is a very good indication. And then 20% rule, which is to do with gross profit margins. So they're really the two that we're going to look at today. For here, these are the stereotypical sources of cash flow problems. Insufficient funding, not enough cash in the business, over trading, poor credit control. Poor credit control is one of the biggest ones. Simple things, when you finish the job, bill it. Sounds stupid, so many people don't do it. We're quite guilty of it. We tend not to bill when the work's done, for whatever reason, and that can cause cash flow issues. Other people are very good. If you have a good credit controller or somebody working in the business, best example I can give probably is Desk Warehouse. Natalie in Desk Warehouse is very efficient, very persistent, but very nice at the same time. Gets her point across either by email, telephone, both, and then resends the email if you haven't replied. So to reply to her, and then she's got next week too. So good credit control is obviously one of the key things to look at. Budgets, very important. I always stress budgets. If you don't know the figures in your business, who else is going to? You can't always rely on us accountants. We can come in, but historically we come in after the event, not during the time. So you need to know your budgets. If you're working in a business where you have seasonal cash flow issues, you need to know when your cash flow problems are going to arise. You need to know when the dip in your sales are. For us, for example, for some reason, August is usually a quiet month. Our VAT is due at the end of September, never good. The quiet month in August, people take 30 days. It means VAT problems the first week in October is always nearly our biggest issue in the year. Just knowing that information can help, because if you know where your problems are, you can do something about it. You can either go out and try and find more clients with a February year end, for example, who want their accounts done in August. Or you can go out and find new avenues of sales and do different things in August to increase sales. So maybe the likes of us, we would look at tax investigation schemes or something like that there that kick off in August, so the renewals will come in around about August time. The other things in budgets, so essential business overview, use credit control to manage debtors more effectively, review your business costs, identify savings, plan expenditure, review debt finance arrangements, and don't live in your overdraft. All pretty simple stuff. Actually, it's, everyone says, oh, accountancy, don't like it, very complicated, but actually it's all pretty straightforward. Common sense. Don't live in your overdraft. If you're living in your overdraft, you have a cash flow issue. Overdraft should only be there to dip in and dip out of. They're only a temporary source of finance. Banks hate to see people in their overdrafts constantly, and that can give you a bad internal credit rating, if you like, with the bank. So you'll go to your bank manager to renew your facilities, and you go, oh well, for the last 100 days you've been in your overdraft for 72 of them. Okay, and then they'll go, so we think it's in your interest to you take out a term loan that you can repay back over 12 months, and then we'll reduce your overdraft facility. And the banks, because of the mess they're in, are squeezing and squeezing and squeezing, and that's one of the tactics they are using. So you live constantly in your overdraft, you're in danger of a bank manager landing on your doorstep and saying, the guys in credit, the mythical credit people, have decreed that this is what has to happen. And all that does is put more pressure on your cash flow, because your overdraft's gone. And only is your overdraft gone, you have to find an extra couple £100 a month to pay off a loan that you didn't want in the first place until it's all cleared. But remember, it's in your best interest according to the bank. So don't live in an overdraft, that'll be the key one there. So I said earlier on, the three main sort of formula, if you like, ratios, call them what you will, to do with cash flow. We'll look at gross profit margin. This idea of knowing when you sell something how much contribution or margin it's making to the rest of the business. So if you're a highly labour oriented business, it doesn't really matter too much, but if you're making something, widgets, adding value and selling them on, then you need to know what that added value is, because the added value has to pay the workforce. And gross profit margins and knowing margins is very important. Debtor days, this is the idea, you need a period of 12 months, and I have a thing here as well to show about debtor days, but a period of 12 months sales, the debtors at any point in time, divided the last 12 months sales times 365. Well, what does that tell me? Well, that will tell you on average how long it takes you to get paid. And if you know how long it's going to take you to get paid on average, then you're not sitting there going, oh, I billed your man last week and that bill next week, so it's 10 grand, hopefully it'll come in. If you know on average your debtor days are 65 days and are slipping out, then you have to deal with that. You've got to go to your customers, you've got to go to them and say, look, maybe offer a discount to get paid quicker, maybe just put more pressure on it, maybe get somebody like Natalie in and just email constantly and ring and talk to you and say, look, what's the problem, I'm going to get a check, as opposed to the other suppliers who maybe you never hear from. You go, well, he's not bothering me, so he'll not get paid. And there's a lot of that going on now. Cash is tight, everyone knows cash is tight, and the stereotypical thing is get your sales in quicker, push your suppliers out. Now that's a complete oxymoron, because if everybody does it, well, we're all somebody's supplier, and somebody's all our customers. So you can't push your suppliers out and collect your customers in quicker, because everyone's trying not to do it. So you can look at other things. Other things we would suggest you look at is discounts. Sounds weird. Why would I give money away? Well, the cost of money is important as well. So for example, say you have £100,000 lying out and you've got an overdraft, and that overdraft's at 7%. So if you're currently at 7% overdraft, that's 7 grand. That's costing you a year. If you average it out, it would cost you maybe 7 grand a year just to have that money sitting in somebody else's bank account. So why not offer a 2% discount to get in a wee bit quicker? You won't get the 100, you only get 98, but you won't be paying out the overdraft fees and interest and everything else. Won't work in every case. You have to know the customers, it has to be specific. You know, as a general rule of thumb, people will take advantage of it. The next time you go to bill somebody, they'll just send you a check less 2%. So it's got to be in special arrangements, special terms, all the rest of it. Know your terms and conditions is another thing, and that all comes back to credit control. So, the 20% rule, let me just see if I can show the debtor days problem a bit better. So this idea of debtor days, right? If our sales, let's put green sales, as it is now, things are getting tighter. Nearly everybody has, over the last 3 or 4 years, experienced some decline in sales. Just matter of fact. Some haven't, but you know, the vast majority have. So if your sales are going very slightly down, like that there. This could still be millions, by the way. Don't worry about it. And your debtors, obviously, you're selling less, you owe less in. But what happens, you tend to find, is the debtors now, it's quite hard to see on a wee graph like that there. This is your debtors. This gap is your debtor days. Because this is how much you sold, this is how much you're owed. And the gap between these two could be looked at as the timing difference between you getting the money in and out. Now obviously, if sales are going down and debtor days are effectively, they're coming down but not at the same rate, you're creating a cash flow issue in here. And really as businesses we need to look at that and say, well, what can we do about it? Can we get this money in quicker? Can we get this reversed and go the other way? So that's part of your cash flow problem, is always nearly in this gap. And it's not something people see because it's not in front of you, you don't see it. You've got to go do the wee exercise, look at your last 12 months and do a rolling 12 months analysis and see, is this gap getting bigger? Because obviously sales fall, what you tend to find, you get fixed assets down here somewhere, and once you hit a certain level, that's where your cash flow problems start. And that would be, I suppose, under trading, maybe, is the way to describe that. What do we mean by the 20% rule? We always say that you calculate your gross profit margin, allocate 20% of that to reserve account upon receipt. Why? It'll cover taxes, it'll cover VAT, it'll cover a multitude of sins. But it'll create a reserve that you know is not really your money. You just set it off to the side. This is really more aimed at the self-employed, the smaller self-employed people, and the smaller sort of partnerships, where you know you've got a tax bill coming in January or July. Yes, there's things you can do. You can buy equipment, you can do this, you can do that, then you can finance for all that sort of stuff. Watch my time here. And you want to be in a position where you can say, I know 20% of what I've taken is in a bank account sitting somewhere that if I need to, I can dip into. But if it's not there, you can't dip into it. So that's more cash management from a cash flow point of view. So we're touching on cash management now, as well as cash flow. Cash flow budgets, keep an accurate and up-to-date budget or business plan to help you manage your cash flow. Again, simple enough stuff. If you've got a budget, I'm going to sell 100,000 widgets in March. You get to March and you sell 90,000. Well, you're 10,000 widgets down. You need to have recorded that somewhere, or at least be in a position to say, well, I know I'm down a little. This could have a cash flow implication maybe in June, because I've got 60 days credit for most people. Or maybe I have to pay for all the stuff for the widgets next month, but last month was a bad month of sales, so what am I going to do? I know we slag off banks. Sometimes they will come in and help. Sometimes you talk to your bank manager and you say, look, I showed 190,000 this month, it's going to come in June, but I've got a bill in May. Can we get a temporary extension of an overdraft? You put a case up to them to show them the figures. Sometimes they'll do it, sometimes they won't. Depends on the banking. So from a budget point of view, you want to update and review your budgets. Now, I think I have a cash flow on here, just to, I'm not sure if I can show it or not. We can't see that, so do that. So all we're really doing here for a second, well, there's your sort of income here. You see that side? All we did for this client was we just said, well, there's your income. You get a monthly backs, comes in once a month. It's usually around about this. These are sort of figures, weekly income. TV license, it's due out in a second, so we stick it over here. You know, on down here, there's NPS subscriptions there, due out the 20th, so from here. So you just build up. I know it looks very complicated, there's a lot of it, but it's pretty common sense. You're just saying, take a calendar basically and stick it on a spreadsheet. Saying this week I think this month will come in, this week that much has to go out by DDs. Put your DDs down there, they total up. You've got down here we've just totaled DDs, so that are going to go out this week. So on, we know the cash in from the top is this, and then checks. So all we're saying is we're trying to manage this business with a £6,000 overdraft for the client. So we're pretty tight here. So maybe what we'll do is we'll say, well, we're pretty tight there. And there's a big check there. So maybe what we'll do is we'll just move that check over a bit. And then suddenly my £6,000 problem in 2 weeks' time has gone down. Now it's still there. But even from bank managers seeing that, you're not hitting your limit all the time. So we things like that there, I just thought I'd show you that. Just it's pretty simple stuff to do. No, forgot this. So cash flow budgets are important. You gotta keep them up to date, and you gotta keep going with them. Finance options then, cash flow, right? What happens if no more money? Maybe we'll get some. Well, what do I need it for? Premises, vehicles, computers, working capital, R&D, innovation type stuff. There are options out there. This is actually taken from an Invest NI slide, so it all looks a bit weird. But you've got internal financing, debt financing, equity financing, and grants. Internal financing, yeah, you guessed it, you stick your hand in your own pocket. Whatever you've built up over the years, whatever you've squirreled away from the business, you've had a rough patch, stick your hand in your pocket and you throw more money at it, on the being hope that it'll work and you'll come out the other side okay. A lot of people doing that at the minute, obviously in a recessionary times. So, types of debt financing, loans, banks, credit unions, overdrafts, credit cards, hire purchase, all these things have issues, criteria. You know, you have to have a good credit rating, you have to have a business plan. You're going to a bank these days, first thing they're asking for now is business plans, or a business case, I think they call it. Put your business case forward, fancy name for a business plan. You know, oh, we're going to sell 100,000 widgets, how, who, to, when, everything else. The banks are now very much, probably the way maybe they used to be, working with you in your business to see how your business can grow. And if you can put a good, viable solution to them, then there is funding out there and they will lend. Equity, again, this is more, we've got a limited company, you're looking to expand rapidly, you're too risky for a bank, you're in construction and you come up with a new way of, putting up timber frame houses or something. Two things there, you're in the construction industry, banks will run a mile. Two, you're in the construction industry, they are by default very backward. That's no offence to Mark and some of the very good architects we have around. And what I mean by that is, builders have built houses for years and they know how to build a house. They don't want somebody coming in and saying, well, do you know if you use this new fangled bracket, everything's easier for you. It might be easier for them, technology might be there, it might work, but the builder goes, aye, right, big lad, I know what bricks do, I know what your triangle is, you know, so you get out of it. So yeah, so equity, so then you're looking maybe at business angels, venture capitalists, investors or a business partner, somebody who's prepared to take more risk but by the same token get more reward. If you are, we deal a lot with the high growth startups in the tech sector, so these guys are looking to go to business angels and they are absolute, I'm not sure what the best term using is, but it wouldn't be polite anyway. Basically they're in, they're putting 30% in, whatever it is, they expect 5 to 7 times return in 3 to 4 years, and if they don't get it, they make a mess of your life. So, be warned, they're out there and they're
You wouldn't use the term angel?
No.
Is that what you're saying?
vulture might be, vulture,
No.
I think of the word, vulture might be better than angel, you know. But in fairness to these guys, they are out there, they will lend, and from a business angel's point of view, it's a numbers game. So they'll take 7 startup companies and they'll invest in 7 startup companies, knowing quite rightly that a third of them will just fall by the wayside within 1 year. The next third will probably struggle, and the last third, maybe 9, will be a better number to take. Do you know what I mean? And all they want out of that is 1 or 2 of those 9, 10 companies to make it, and they'll make their money back. Because that's why they're on a 5 to 7 times ratio. So it's just a numbers game with those guys. Grants then, Jennifer, very well placed to guide you through the maze of grants available in terms of finance options through different government agencies, Trade Ireland, Invest Northern Ireland, ENI. The ones we would deal with predominantly are the tax relief and alliances with things like R&D. And the government guaranteed lending schemes, another one that's sort of floating around, it's sort of getting here and not getting here and stalling. And it is there, you can sort of go find it. It's got a new name now, I can't remember what the new name is, but every week it has a new name. So in terms of cash flow and financing, there are grants out there, there's equity financing, there's debt financing, there's internal financing. There are ways to solve your cash flow issues. So I think that's probably just about 10 minutes, maybe slightly longer. So I'll take any questions. Any questions for Sam?
Simon, why do you think so many small businesses are so bad on cash flow? I'm just thinking personally of people who've done work for me, and I've been waiting now months and months on a bill arriving. In fact, I've got to the point now where I refuse to ask for bills because I think I shouldn't have to ask for it. But why do these people never catch on that when you provide a service, deliver a good or whatever it is, you have to get that money in reasonably quickly, because the other big danger is that the longer a debt remains outstanding, the chances of it becoming unpaid increase the longer it lies.
The main reasons are, in the current climate, I would suggest it's just a time factor. You get a lot of small business, and we see it, who are running around scrambling for work, to get work done, to get work in. They're trying to get their diaries filled, they're trying to do all this. They're getting home, they're exasperated. It's a stressful, don't believe it's not stressful to run your own business. It's very stressful. And the last thing someone wants to do when they get home at night is sit down and do the books. And it's this back office section that we would say is where a lot of people fall down. You just forget about the back office stuff. All this stuff I'm talking about, you know, doing budgets, doing cash flows, doing all this sort of stuff. I know there's people around this table sitting there shaking their head, I haven't time for that. You know, and I haven't got money to employ somebody to do it. So I suppose really where the real problem is time. I don't think people have the time to do a lot of this stuff, but they need to invest a bit of time. It's the old adage, you know, you need to work on your business, not just in it. And you need to spend a bit of time every week, even if it's an hour on a Friday morning or whatever, doing your bills for that week and getting them out in the post. So the bills arrive on a Monday or Tuesday. I think the best day for a bill arrives on Tuesday actually. I don't know why, but I think there's some theory out there that if you post your bills out here Friday evening, you'll get Monday, Tuesday, there's a better chance of getting paid than if you post them on Wednesday. Who knows why that works, but there you go. So yeah, time, I would say is the answer to that, why people are so bad at it. Bill often and bill small is what we always had hammered into us. But even as accountants, we would tend to wait and bill one big fee at the end of the job. If you can get a job where you can bill in increments, that's brilliant. You just go ahead and do it if you can do that. But again, it doesn't work for everybody. You know, I don't think Duncan's likely to come to me and say, well, you buy one leg of that chair this week and pay for the second leg next week, third leg the week after, 1 week before we deliver the chair. You know, it just doesn't work in some circumstances, but there are others out there who do it. I mean, Mark's probably a prime example where they tend to charge a fee sort of at the design stage, and then implementation, and then build, and then a final fee at the end.
Do you recommend any software for people like Zero or those sort of things, or those sort of online, like those sort of cloudy type ones that you know?
For accounting or
yeah,
for?
well, sort of for that sort of cash, for keeping an eye on things, that kind of cash flow sort of stuff that you can access as well as the customer, you know, that sort of idea.
Excel. Why go to an online? I mean, there's plenty of online solutions out there now where, well, if you think about it, the two things you're going to want to do is probably you don't have time to do cash flow stuff, then leave it up online for me to go in and look at it, for me then to contact you, for you to go back and look at it. So maybe a better solution in that scenario is to have just an Excel sheet, which you can use something like TeamViewer or Dial Me In or Log Me In or whatever it is. You sit in front of your PC and say, wonder about this, ring me, I can dial in, we can look at it together, while you have the time there and then, do it, it's done, and you keep it.
If you're working for like local government and you know they take longer to pay you, how do you work in your profit in that then when you're waiting so long to get paid, where it could be like 2 to 3 months more?
That's just where cash flow management, cash flow planning comes into its own, because then you're saying, I've got a government contract, we know you're guaranteed the money, pretty much it's a government contract. The problem is the bureaucracy means that 5 people have to keep themselves in a job and you need to wait 3 months to get the money. Because Joe has to look at the invoice, Pamela has to check that Joe looked at the invoice, Stephen has to check that Pamela looked at Joe looking at the invoice, and then check that the amounts are right. Vicky has to come along and check that Stephen got it right for Pamela and Joe. At the end of the day, Margaret, who didn't give a monkey's anyway, just hits the back spot and sends the payment. But that takes 3 months. So you build that into your cash flow, so you know if you're doing a job now, where we start in November, government job, 20, 30 grand, you can expect payment mid-January probably, depending on the contract and how you're on with. Keep at them is the thing I would say.
You forgot to say the external auditor made them do all of this, not right. Stand up for you.
Oh, I think that was the internal auditor, probably not the external auditor.
All doing the external.
All doing the external auditor. Oh,
Simon, what you didn't mention there, and I'm interested to hear your views on the ability to charge interest on late payments. Because
Yeah.
that has all changed now, that you don't have to historically have it on your invoices, so you can go back now and start charging interest.
Yeah, I mean, I think that's one of those ones that is about 2002 Debt Act or whatever, I can't remember the name of the legislation. It's on another presentation there, but you always did have the ability to go in and charge 8% above the government's base rate. So, base rate's 0.5%. Anything over, I think it's 30 days. I mean, I think they assume the standard terms unless otherwise agreed was 30 days. So once you hit a 30-day period, you can go in and charge 8.5% interest on that account. Now,
So I guess if you're getting difficult, if a person having
Yes.
difficulty paying in the first place, the £10
Yeah.
covers you, but the chances you get them.
Well, I'm thinking of the likes of
Yeah.
the government, because we've now started to charge
or the
the
government.
government
Yeah.
8% interest.
I might not, yeah. That's not one I've sort of given too much thought to, but I suppose you could try it and see. You'd probably get some government procurement guy coming down saying, well, it's in our terms that we have up to so many days to pay you, and therefore this doesn't apply. And if it's in a term contract, and the problem with government is there's going to be a contract somewhere, you might never see it, but it's going to be there. But yes, you do have the ability. Just generally though, I think it's a question of, is it a scare tactic to try and get people to pay you more than a reality? I think in Northern Ireland we're all a little too nice. If that's not being unkind to us, we don't really like to say, we would rather work with customers to try and get the money off them in its entirety, as opposed to get their backs up and everything else. But I think we're just a little too nice. I think if you go to England and Wales, that's pretty common. You get a bill for 8.5% of whatever you haven't paid. That just arrives in the door and you're expected to pay it. So it's maybe just a mindset thing over here. My personal views are use it if you feel it's an appropriate tool to try and extract money out of somebody. But we all have the right to do it.
Okay, anybody else? Right, okay, thank you very much, Simon.